Two of the all-time greats in stock market investing, both Warren Buffett and Peter Lynch, will both tell you that individual small investors have a number of distinct advantages over large Wall Street firms, institutional investors managing billions and billions of dollars. Now, in this video, we're going to go through the top 5 advantages that us as small individual investors have over those large fund managers so that you can take advantage of those things as much as you possibly can in order to hopefully improve your returns in the stock market. Now, before we get into that, we do have a sponsor for today's video, and today's sponsor is Hatch. Now, Hatch have been sponsoring the channel for several months at this point, and they have been my personal broker of choice as a Kiwi looking to make investments over in the US. I use Hatch predominantly because of very, very low fees to what I have paid in the past with one of the large banks. To put things in context, you can buy up to 300 shares in a US company with Hatch for as little as $3 US. If you take something with a really large share price like Amazon, for example, you can buy close to $1 million of Amazon stock, 300 shares in Amazon, for only $3 US in brokerage. So it's very, very cheap relative to many of the alternatives, especially the big banks. And that's one of the main reasons that I really, really like Hatch. They also have continued to improve the platform over a long period of time. They write several really informative blog posts, of which I've been helping contribute to, so I may be slightly biased there. So if you're interested in getting started with Hatch, you will need to head to the link hatch.as/investingwithtom. If you deposit 100 New Zealand dollars into your new Hatch account, you will get a $20 top up so that you can get started investing with a little bit more cash. Now, without a shadow of a doubt, the number one advantage that small investors have over institutional fund managers is simply their size. Now, although managing smaller amounts of money might not sound particularly exciting versus managing billions and billions of dollars,
billions and billions and billions and billions,
it does create the opportunity to find smaller, less followed companies that are more likely to be mispriced in the stock market. Now, recently I've been reading a lot of the Berkshire Hathaway shareholder letters. I'm up to about 1986, I think it is. Been reading right back to the 1950s from the original Buffett partnerships. And one of the things that Buffett has actually been talking about right back from probably like 1960 or 1970 when he started getting into the millions of dollars to manage is how size can really be a weight on your stock market returns. Now, I've done videos on this on the channel before, and the story basically goes like this. Now, if someone like Warren Buffett, who currently has something like $150 billion in cash on the sidelines, wants to make a large investment in the stock market, there is a very, very small number of companies that he can put a significant amount of that capital to work with. Something probably in the 15 to 30 company range in the entire world. Compare that to the thousands of companies that individual investors can put their money to work with. It's no surprise that Buffett, over a long period of time, regardless of him being the greatest investor on the planet, has been able to outperform the market by less and less over a long period of time. He simply has less investment opportunities to put his money to work with, whereas we as small investors can look at the massive companies, we can look at the multi-trillion-dollar businesses like Apple, and we can also look at tiny companies with market caps of maybe $50 million here in New Zealand, over in the US, over in Australia, in all sorts of countries. We can focus on tiny companies or we can focus on massive companies. We can simply just follow the best opportunities. Now, the second advantage that we have as small investors is that we have zero worries about something called the institutional imperative. Now, the institutional imperative basically goes like this. If someone is paying you to manage their money, they expect you to do something. And we know that for the most part, successful long-term investors are very, very good at not making frequent changes to their portfolio. Fidelity have done a study on this, which I've mentioned on the channel several times before, which basically said their best investors, the ones with the greatest track record, the highest returns, are people that either forgot they haven't had an account with Fidelity or they were dead. In other words, they were making absolutely no changes to their portfolio. They weren't racking up fees for brokerage or paying tax on capital gains or things that would kind of detract from their investment capital. And they weren't making rash kind of spur of the moment decisions either. So we, luckily as small investors, don't have people knocking on our door asking us, have you done anything for us today? Have you found a new company to invest in? What tweaks have you made in the portfolio in order to try and maximize the performance and all that sort of thing, we can sit back, wait for investment opportunities to come to us, and in the meantime just let our portfolio sit there, and when the big opportunities come along we can swing at them, but in the meantime we're not pressured into doing things that are going to harm our returns. Now, the third major advantage for small investors is something called cash. Now, we all know what cash is, and we all know why it can be really useful to have sitting in a portfolio. Basically, if we have a portion of our portfolio sitting in cash, if we find big fluctuations in the market, or if we have new businesses that come across our desk and they look really, really attractive, then we have some firepower in our portfolio to put to work and capture those really good returns because you're able to buy great assets at really attractive prices. Now, if you look across at the mutual fund industry, cash is a dirty word. People talk all the time about this concept of cash drag, which is very real, and it basically goes that if you make, say, a 10% return on your invested capital, but you had, say, 10% of your capital sitting in cash, which was generating basically zero, then you're actually not going to achieve that 10% return that maybe the stock market did that year. You're actually going to produce maybe only a 9% return because you've got 10% of the portfolio sitting in cash. Now, many large investment funds have a extremely diversified portfolio, and they basically are tracking the index. So cash drag can be really detrimental to their long-term performance. But individual investors focused on individual companies can really benefit from having cash. And even someone like Warren Buffett, who has set his Berkshire Hathaway business up a lot like an individual investor might build a portfolio out over time, has actually been able to take advantage of having cash there as well. Through the depths of the 2008-2009 recession and stock market crash, he was able to put a lot of capital to work. If you're forced to be fully invested and have no cash, as many institutional investors are, you can really be caught out with some of the greatest buying opportunities of your lifetime through deep stock market crashes and just not have the cash or the firepower to buy and accumulate those great assets when it's really, really beneficial for you to do that. Now, advantage number 4 for small investors is this concept of permanent capital. Now, when I was fairly early on in the world of discovering particularly Peter Lynch and reading his book, One Up on Wall Street, I was doing some reading outside of that book. I finished the book. It's great. If you haven't read One Up on Wall Street, I highly recommend it. But I was looking into Peter Lynch after reading that book, and I found this stat that just absolutely blew my mind. And it basically goes like this. Now, Peter Lynch is one of the greatest mutual fund managers, if not the greatest of all time. He returned something like 29% a year to investors when he managed the Fidelity Magellan Fund. But the average investor in that fund actually lost money. Now, how does that happen? How does someone go from earning 29% per year in a fund to having the people in that fund earn 0%? Well, basically, it's because that fund of Peter Lynch's was not an initial pool of capital that was grown over time where capital wasn't pulled out or new money put back in. And in fact, it was sort of this moving beast where when Peter Lynch did really well, he attracted a lot of new money. And when Peter Lynch did poorly, a lot of people pulled their money out. A lot of investors, unfortunately, particularly in institutions, are momentum investors. When they see hedge funds and mutual funds doing well, they'll get a lot of money after they've already made the good returns. And if Peter Lynch has, a couple of bad years, they will pull all the money out at the worst possible times. Now, that is basically the reason why individuals essentially got no return, and Peter Lynch's fund overall did like 29% a year. And that's not something we have to worry about again as individual investors. We have permanent capital. If we earn $10,000 and we decide to make investments with that, no one is going to pull that $10,000 out right at the worst possible times. We have the opportunity to take advantage again of fluctuations in market prices, which a lot of that is really the theme of this video. If prices get low, we're not going to have someone else pull that money out. We're going to have the opportunity to hold on to those investments and possibly put even more capital in, and vice versa. If prices get really, really high, we're not going to be forced to chuck a whole lot more money into the market at really unattractive prices. So permanent capital is a huge advantage, and in fact a couple of professional investors have gone down the track of trying to set up a permanent capital structure. Berkshire Hathaway is a great example of that. So Berkshire Hathaway is a publicly traded company. They are not a hedge fund or a mutual fund where people can put their money in and pull their money out. They can buy and sell the shares, but when they buy and sell the shares, that is not taking money away from Warren Buffett or giving money to Warren Buffett. He has a permanent pool of capital that he can manage over the long term in a way that will generate the best long-term returns for the owners of that business. Now, the fifth and final advantage that we're going to talk about in this video for individual investors is this concept of liquidity. And liquidity basically describes how easy or how difficult it is to buy and sell a particular asset. And when that comes to the stock market and you're a small investor, you have a lot of liquidity unless you are in extremely small companies like tens of millions of dollars or less. You probably have a reasonable amount of liquidity. If you want to put $100,000 into Apple or extract $100,000 into Apple, which for most individuals would be quite a sizable trade, you can do that in the snap of a finger. You can do that in seconds because Apple has, it's a large company and it has millions and millions and millions of dollars traded every single day. So you can get in and out with even quite substantial percentages of your portfolio pretty quickly. Now, if we look at large institutional investors that manage billions of dollars, that process often is not as easy. And even with the largest companies in the world, if you take someone like Warren Buffett, it took him over a year to accumulate his stake in Apple. He made Apple a huge percentage of his portfolio. He put somewhere in the mid $20 billion kind of range into Apple, but that process took him over a year. And through that period of time, the share price moved from the low $100 range to something like about $160, and it kept continuing upwards after he'd accumulated his stake. And he's publicly said in interviews that if the price was lower, he'd probably still be buying it. Now, that is a substantial disadvantage of being a large investor. You don't have the nimbleness and the flexibility to just instantly accumulate all the position in the stock that you want or instantly sell out of a position really quickly. If you're investing with huge amounts of money, even in the largest companies, it can take a really long time to build up a large investment in a particular company. And it gets even worse if you're investing in really small businesses. And that's basically the reason, like we talked about at the start of this video, why many large institutions only invest in huge companies. Now, Warren Buffett, even amongst institutional investors, is an extreme. He is managing about as much money as anyone. So he struggles even with the largest companies like Apple. But the average institutional investor can still struggle even if they're investing money in a company worth tens of billions of dollars. But for small individual investors like you and me, we can probably put our whole portfolio to work in one company in like 10 seconds. So that is not a concern for us, and that is a great advantage. It expands our investment universe to a larger number of companies, and when we do get those really extremely attractive prices through certain market fluctuations or through certain events happening with individual companies, we can initiate a large stake when those prices are really attractive and not have to capture a whole range of prices both on the way down and on the way up. That could make our overall cost basis a little bit higher. So there you have it. Those are my top 5 advantages for individual investors. I do hope you enjoyed the video. If you think I might have missed anything, drop a comment down below and let me know other advantages that you think individual investors also have. If you're interested in the Hatch offer, I will again put the link up on the screen here, and it will be down in the description below to go to hatch.as/investingwithtom. But that's all from me today. So if you did enjoy the video, please hit like and hit subscribe, and I will see you in the next one. Cheers.